Hello and welcome back to Bunnex Investment Group. In this video, we will discuss how 21 pips can be a powerful amount to get every day. So this video will clearly illustrate how you can catch these number of pips if you follow all the concepts that we will discuss. But before we jump into the whole video, make sure to hit that subscribe button and check the notification bell icon so that you'll be notified each and every time I upload a new video. Please check out our free Telegram channel where we share free signals, trading advice, as well as support. The link is down below. So here is what we will go through in this video. We'll talk about the 21 pips equity growth concept, steps to catch the 21 pips, and the last but not least, the chart illustration, whereby I will show you exactly how to do these concepts in practical motion. So here's the 21 pips equity growth concept. You may be probably asking yourself, why 21? So the first thing is 21 pips is a number of pips that can be obtained within one day, since we've said this video is an intraday guide. So this goes down to the fact that we'll be risking only 7 pips per trade. Therefore, to have a 3:1 reward to risk ratio, we multiplied the risk by 3. So in simple terms, a 3:1 reward to risk ratio means one win may cover 3 losses at once. This will decrease the positive expectancy on our system as illustrated by the example below. So let's take, for instance, this trader takes 10 trades. So in a series of 10 trades, the trader wins 3 trades and loses 7 trades. In terms of accuracy rate, we would say that this trader has made a 30% accuracy, met a 30% accuracy rate. So he only got 3 out of 10 correct. So putting this in our model, it means winning pips are 3 multiplied by the number of pips on our target side, which are 21, and the answer is 63. Then losing pips are 7, which are the losses multiplied by the 7 pips we risk on each and every trade, and the answer is 49. Then the net pips is 63 minus 49, which is equal to 14 pips. So 14 pips is equivalent to 2 multiplied by the risk percentage on each and every trade, which is 2R. So 14 pips multiplied by the lot size that you are using, depending on your account size, will basically means that you are in profit. So this is basically from an accuracy rate of 30%, only 30%. That means out of 10 trades, you won 3. Out of 100 trades, you won only 30. So before we go any further, we are not implying that this strategy that I'll illustrate on the charts is a 30% accurate strategy. It means this was basically to illustrate that even with a very, very low accuracy rate, you can still make it. So this is to reduce the positive expectancy, to reduce the expectation of higher yields, but to give you the rightful mindset. So here are the steps to catch the 21 pips. To catch these pips consistently, one needs to be highly analytical. This means you need to monitor the chart carefully to obtain the optimum point of entry. So the first step is to count. The count is necessary. By counting, we mean to count the M15 levels or to count the M15 impulses. It's not difficult because I've incorporated some things that can help you to do the count. So the count may start from the previous day or the previous 2 days, depending on the pair you are monitoring. So this is a peak whereby you would see or you would find on the previous day or even after the previous 2 days. So from this peak, you will need to see a flow of the market, then a bounce of price on either 13 EMA, that is exponential moving average, or the 50 EMA, and then the flow of the market, then another bounce on either the 13 EMA or the 50 EMA, then the market flow to give us the last level or the last impulse, then monitor this leg as it forms, and our entry point will always be on the second leg of this pattern, which is basically a W, and then ride the market to the 200 EMA. I will show you on the charts, don't worry. So here's the step 2. This step follows after making a count of the 3 M15 segments. In order for us to get an optimum entry point, we will need to see a clear M or W. However, seeing the word W or M form in front of us will widen our stop loss. Therefore, we will need to enter at the same region of the first leg. Let's go on the charts for illustration of the discussed concept. So this is pound against the dollar, and it is the pair that I will use to illustrate. It doesn't mean that this concept only applies on pound dollar only, but it applies on any pair that you wish to trade. So as you can see, we are going to use the previous 2 days from this current day for illustration sake. The first thing, as I said, is to see where a peak was issued. I'll use some rectangles to see where the previous peak was presented. As you can see, at this point we had our peak. However, this peak was not an M, but it was the highest point or was the last point for us to start our count. So we are going to start our count from this point. As you can see, from this zone we had the first drop or the first push impulse going down. After that, the market came back to the 13 EMA. In this case, the 13 EMA is in red, the 50 is in blue, and the 200 in white. These are the only EMAs that are necessary whenever we are applying this concept. So there was a first push, then a bounce of price on the 13 EMA to show us that this push was now complete. We were now starting another push on the 13 EMA going down. As you can see, we had the second push and a bounce on the 13 EMA. Then after this, we were now expecting to see an impulse going down again, then a setup to be issued for us to get our entry of a magnitude equivalent to 21 pips, basically a magnitude that is equivalent to a movement up to the 200 EMA. As you can see, we had our setup, and this was the region of the first leg. This was the region of the first leg. So after that, after seeing some rejections, the first thing that we need to see are rejections, or to see a nameable pattern on the lower time frames, on M5 or even M1, to see some rejections within the region of the first leg, then enter. And I'm sure our trade was going to be somewhere at this point, because on M1 there were rejections presented at this point, which I can't go because it will be very, very far to go back, scroll back with the M1 time frame. Then our 21 pips was actually going to be met. So after having this small cycle, we expect to see an M on the 200 EMA. As you can see, on the 200 EMA, we were issued a very big M, which gave us another entry point in the zone of the first leg like that. So in this zone, we were issued some rejections in the M5 and in the M1 time frame, and from this point we can see that the market gave us an impulse, right? Then a bounce, and from our template we said a bounce on 13 or on 50, right? This time it came back to 50, then another impulse, as you can see, then a bounce on the 13 EMA, right? Then after that, here we had the region, and it failed to actually reach the region of the first leg, but aggressively you might have seen that the market is now going up. So this was the first cycle, and our entry was at this point, and our 21 pips was going to be caught. And in this second cycle, we could enter in this region of the first leg, and our 21 pips was going to be met. Then at this point, I would say if you were an aggressive trader, which I'm not, you might have taken this trade, but the second leg did not reach the zone of the first leg. So after that, you can see that the market has made its first impulse going up. After first impulse, we can see a bounce of the price on the 50 EMA, right? Then after that, we had another push from this point to that point, and a bounce of price on the 13 EMA, like that. So what are we now expecting? Basically, we are expecting to see a beautiful first leg. Then after seeing that beautiful first leg, we'll need to mark that zone of the first leg, and when price comes back in that region, like that, in this region, we'll then take our entry without fear. So some traders that I have trained before actually take trades even within these mid cycle impulses. For instance, if he sees that this is a peak, a bounce, then a push, then a retracement to this zone, he can actually take another trade equivalent to a 21 pips, and do so in each and every cycle. As you can see, at this point the market bounced at the 50. Someone could have taken another trade, and so forth. So that's basically how you can catch the 21 pips against a risk of 7 pips each and every day on any pair of your choice. 21 pips is probably the shortest ADR a pair can move each and every day. So that's it, and we come to the end of our today's video. Thank you for watching. Like and subscribe, and check out our Telegram channel.